Charitable Remainder Trust. So kind of a description of this, irrevocable trust intended to reduce taxable income by first dispersing income to trust beneficiaries for a specified period of time, and then the remainder to a designated charity. So there's a lot of rules and mechanics in this. Greg's gonna go over that in a second. Some of the key limitations, once the assets are placed in the trust, they generally cannot be taken back or changed. And so again, you'll hear control, you'll hear a lot about the Deferred Sales Trust flexibility versus the handful of other strategies that are out there. This is one of the limitations for a charitable remainder. And then the second key thing that we really see is the fixed income does not protect against inflation, right? So you look at the inflation that's we've been dealing with over the past couple of years. The charitable remainder trust puts you at a disadvantage in that sense. So if you want to kind of dive deeper into that one, Greg, but that's really an overview of the CRTs.
Very good. So yeah, charitable remainder trusts, I would say they're not as popular as they have been in the past, but they've been around a long time. And really it has tax benefits, which I'll go over, but in my view, the primary criteria of whether or not to use a charitable remainder trust is when you have a charitable inclination in mind. You're not in it solely for the tax benefits. You really have a desire to benefit one or more charitable causes or charitable organizations. And so that should be a part of it and not just looking at this thing for the tax benefits. So how do they work? So one of the things about CRTs is that you actually have to, you're usually using that to sell some highly appreciated asset, such as real estate, such as a business, such as highly appreciated stocks or bonds or things of that nature. And you have to create your trust before you start the process of selling your asset. It has to be in place first. Most of these other things don't have to actually be in place ahead of schedule or started ahead of schedule. Charitable remainder trusts do. You have to kind of decide on that path. You have to know that you're going to sell this particular asset. You're going to have to create the trust and the terms of the trust around it. Then you're going to put the sign in the ground. If you do it ahead of time, the tax benefits that you're eligible for may not be granted by the IRS. So that's the first thing. You got to really plan far enough in advance on a charitable remainder trust. So how does it work? So let's say I'm selling a highly appreciated piece of real estate and I want to benefit my alma mater and the March of Dimes. It can have more than one charity that you want to benefit, and that's fine. And so you create the trust. The trust is going to have two sets of beneficiaries. The first beneficiary is going to be the income, and this is a charitable remainder trust I'm speaking about. There are flips on this, but charitable remainder trust is going to have an income beneficiary, which is typically the donor or the client, who is going to be receiving income for their lifetime or a specified number of years, which we'll cover. And then there will be a remainder beneficiary, which will be one or more charities. So that means that when the income period, going back to the donor, typically ends, whatever's left in the trust is going to be distributed outright to one or more charities that you've designated in your trust. Now, it is an irrevocable trust. However, the one thing you can change over time is the identification of the charities. And the charities you name have to be qualified charities. In other words, they usually have to be registered 501c3 organizations registered with the IRS. So they scrutinize them, they determine what their mission is and all the things that surround that, and they will confer upon you that 501c3 status. And they all have a determination letter. And if you're ever thinking about donating to charity and you want the tax write-offs associated with it, you want to get a copy of the determination letter that proves that they're qualified charities. Otherwise, you don't get the tax benefits. So what happens is you create the trust, you identify the income beneficiaries, which would be the donor or the donor and the donor spouse typically, and you elect whether you're going to take lifetime income from the trust or you're going to designate only a period certain for income to be paid out before the charities, kick in as the direct beneficiaries. So that fixed number of years can be anywhere up to 20 years and no more, either lifetime or a fixed period up to 20 years, if that makes sense. Now, you also get to choose the level of income that has to be tested, but you get to choose the level of income as a percentage of the trust assets that you want to receive on an annual basis. There's a minimum of 5% that you would have to draw and a maximum of 50%. But before you get too excited, nobody ever gets 50%. You'd have to be 99 years old in order to qualify to take that much. There's a test that is run, and your CPA can run it. There's software specifically for this purpose. We have it. We can run these tests as well. But it will take your life expectancy if you're doing a lifetime payout, or it will take your age in a period certain number of years. Because the idea is that the IRS grants you certain tax benefits with the proviso that at least 10% of the original corpus of the trust should be available to be distributed to the charitable beneficiaries at the end of the road when the income stops to the donor. Now, they developed a test up front because in the past, before they really had these tests that they could do, they kind of had to follow up with you a lot to find out if the corpus of the trust had fallen too far while they're giving you these tax benefits, because if the corpus falls below 10% of the original amount, theoretically they take away all your tax benefits that they might have given you, right? So it's almost like collapsing the thing, but the charity still gets the money, but you or your family get stuck owing the taxes. And so they don't have the manpower, the bandwidth to, watch every individual case like that. So they came up with this test, and they determined a probability that there would be at least 10% of the corpus of the trust available. And in doing this calculation set, they're making some very, very, very conservative assumptions. Like they're going to assume that the trust is only going to earn maybe 2 or 3%. So that's one of the limitations. So what we find is most people, to get the qualification to get the tax benefits, are going to be taking somewhere between 5 and 8% as your annual income against the beginning balance of your CRT. Now, there's really kind of two versions of the CRT. One's a Charitable Remainder Annuity Trust, and the other one's called a Charitable Remainder Unit Trust. Just to keep it simple here, the annuity trust means that you identify the percentage, it passes the IRS calculation test, and let's say it's 8%. Let's just say that's on the high end. Let's go down and say 5%, because that's probably closer to the truth. So if you started with $1 million donation into this trust, that means that you're going to be taking, if you pick 5%, $50,000 a year, every year for either the 20 years or for your lifetime, whichever way you choose to do that. And that's going to be a stable, consistent income. No increases in the future or anything like that. If you use the unit trust approach, and then with the annuity trust, you can only make one donation into that trust. With a unit trust, you could conceivably make more donations over time into the same trust. And then the interest rate that you select will be evaluated against the end of year balance of the investments, and that will determine your dollar income for the following year. So, example, you start it with $1 million, you pick 5% as your payout rate. So for the first year, you'll collect $50,000, payable once a year, monthly, however you want to do it. At the end of the year, the trust is valued. And let's say if the trust increased in value, it was up to $1.2 million. Let's say it made 20%. Then you would apply 5% payout against that $1.2 million, and that's your income for the following 12 months. So you actually would get a little bit higher income for the following 12 months. At the end of the year, once again, everything gets revalued. Let's say the markets really went down and the investments went down, and you've got less than $1 million at the end of the year. You're still going to apply your 5% against that new balance. And so that means for the next 12 months, your income will be less than your first year's income. So with a CRUT or unit trust, the income that you may receive is going to be somewhat variable. Some people that want to have, try to predict an increasing level of income to try to keep pace with inflation, they're generally going to pick a lower interest rate for their drawdown rate and hope that the investment returns are higher than that so that the underlying corpus is going to grow. But, those are just some, details about that. Now, let's talk about what the trust can invest into. The trust will have some limitations on what it can reinvest into. You get to approve and determine ultimately what that trust invests into. You're usually going to work with a CPA for the tax reporting features, and you're going to work with a financial advisor in most cases to try to put together an investment portfolio that's going to meet your objectives, and also try to make sure that at the end of the line, there's at least 10% still remaining that can go to the charitable beneficiaries, because that's part of the deal. But charitable trusts have what's known as prudent investor rules tied to them, meaning that you don't have everything in the universe of potential investments that you can invest into. A lot of times you can't invest back into real estate. You're not going to be able to invest anything into crypto. You might not be able to do hard money lending. Certain things that just don't fit within that prudent investor rule category. And you can look up that term and Google that term if you like, just to see what kind of investments are within or outside of prudent investor rules. So sometimes that can be a limitation for people in terms of that, but at least you do get to decide what those investments are. That's not out of your hands to make those decisions. You're just going to have to follow the guidelines. What else about charitable trusts? You can't really make any changes other than maybe modifying who the charitable beneficiaries are. You can't change the drawdown rate. You cannot access lump sums. You cannot borrow against the money or anything of that nature. You will get some tax benefits. So you get two sets of tax benefits. One is a charitable deduction that allows you to shelter some of the income that comes to you from the trust. Because what the trust does up front is, once you create the trust, put the sign in the ground, and then either transfer the title of the real estate or the business into the trust, and then put the sign in the ground and then sell it, because you want to transfer the assets before it's sold into the trust. Just like you have a living trust, when you're done, you transfer title into your trust. You have to transfer title of your assets to the charitable trust before you put the sign in the ground to sell the asset. So now the trust is the owner, the trust sells it. At the time of sale, all of the capital gains are forgiven. They're not deferred, they're avoided entirely. Now, the earnings thereafter, once it's invested, are not tax exempt at all, but you'll get some tax benefits that will shelter some of the income. And kind of the rule of thumb is, maybe 2, 3, potentially 4 years worth of your income, just depending on what you choose, will be sheltered by the charitable gift deductions that you're going to receive. After that point in time, you're going to be taxed on the money you receive out of the CRT. So those are the two first benefits. Avoid the capital gains up front, shelter income for a few years maybe that's coming to you out of the trust. And then at the end, since the remainder of it is going to charities, you get a credit against your estate. So if you had a bit of a larger estate, maybe you would otherwise be subject to estate taxes. This is outside of your estate because it's going to charity. Another drawback to charitable trusts, especially if you have a family and children who are your natural heirs, is that you're taking an asset kind of off the table for your family. You're going to generate some income for yourselves, sure, but when you pass away, instead of that asset going to your designated children, it's going to go to charities. So you're taking some assets off the table that won't go to your kids. Now, there is some planning around that can be situated, often using a irrevocable life insurance trust, whereby you might take some of your income coming from your charitable trust, use that to make premiums on an irrevocable life insurance policy inside of an irrevocable life insurance trust, so that when you die, the assets remaining in the trust go to the charity or charities, and the life insurance proceeds, because it's payable on death, goes to your family. And they would receive that money tax-free. And so that's a way to try to cover both bases if that's important to you. So that's an important note I wanted to make there. So covered tax benefits, covered mechanically how it's set up, covered two types of charitable remainder trust, the annuity trust and the unit trust. So again, appropriate consideration for folks that have a pretty deep charitable bone in their body, that they really want to benefit charities. And so that could be a good strategy to consider in that situation.